everyone, welcome back to my channel and welcome back to another video. Today we're filming another chitty chat. So today we're talking about how loans are a trap, and as a young generation we don't need to fall for them, okay? No one talks about it, but I'm here to say it. So let's dive in. $18 trillion, $37 trillion. What do those numbers mean? I'm here to tell you that $18 trillion represents the amount of consumer debt in the United States. The $37 trillion represents the national debt, which I've talked about before on my channel. Do you know what the difference is between the United States as an entity that owes money and the individuals that make up the United States who have consumer debt? The United States does not have anxiety about the debt that it owes. But those citizens who have our consumer debt probably do have anxiety. Studies have shown that people who have debt often struggle with the following: depression and anxiety, and physical wellness issues such as headaches, issues going to sleep, lack of quality sleep, and an inability to focus or function. So with all that said, it's amazing to me that debt is normalized. This is random, but most of my videos are random anyway, so this should not be new. The Sesame Street character that I relate to the most is actually Big Bird. So I'm going to use an analogy now to explain something. It's easy for me to sit on my perch, which in this video is my staircase, and tell you that debt is terrible and it's not worth it. Well, I agree with that statement, but I also understand it. I've been in situations where life changes have caused me to make split decisions regarding a purchase, especially a large one like a vehicle. Now, a few years ago, back in 2020, people said that cash was no longer going to be used and that Bitcoin would take over. I'm not sure that we're there just yet, but what I am sure of is that cash at the moment is still king. And when you go and make purchases for large items, you use cash or you write a check. Now let's get into the fruit of this video. Let's talk about car loans. I've talked about this before. I would not recommend a car loan to anyone. No one. Doesn't matter how good the interest rate is, no, absolutely not. Unless you absolutely have to. Having a payment that you have to pay to someone every single month is an absolutely terrible feeling. In fact, owing anybody money should be a terrible feeling because that's exactly how it is. It really does take up your mindset. It, for lack of better terminology, eats you alive. The anxiety of what happens if I can't pay this? What happens? What happens? What happens? Fortunately, though, it only takes one time. Well, for some people it takes more than one, but it only takes one time to learn from that mistake. So now we're going to talk about college loans. I have people in my life who went to college when the cost per credit hour was about $165. Oh, excuse me, actually I think that was the cost per class. So if you divide that by however many credit hours, it would be like less than $50 a credit hour. Of course, that's not the reality we live in today, considering I pay $1,500 a class now for my grad program. In fact, the next time I actually enroll in a class, it'll probably go up in price. The only thing I will say, if you're going to take out loans, do it for a degree that is going to actually benefit you. For the love of your own sanity. Business, law, you can't go wrong with a business degree, and even like a communications degree. But don't take out a loan for a degree that's not going to serve you, no matter how passionate you are about the subject. Because at the end of the day, your goal, if you're going to college, is to get through and be able to work in a business or create a business for yourself. So nothing wrong with a business degree. And you know what? I have not ever shared this story, but I actually changed my major when I was in college. See, now I'm getting off on a tangent. 3 months in, from criminology to journalism. And that was a pivotal moment for me because I don't know what I would be doing with a criminology degree right now, but I can tell you one thing, my communications degree has served me exceptionally well in my marketing and the way I communicate, although sometimes that does not come across very well on YouTube because I tend to stutter a lot or what have you, but in a professional environment, that has served me exceptionally well. And to be honest with you, I wouldn't change a thing about my college experience and my degree that I majored in. I truly would not. There's a cap on student loans officially as of next year. And contrary to what the mainstream media will tell you about this cap, this is not a new idea or a new thing. In fact, let's go back to 1992. Congress actually passed the Higher Education Amendments of 1992, which created the Parent Plus loan, letting parents borrow up to the full cost of attendance minus aid. They also expanded the Grad Plus loan, letting graduate students borrow as much as school would cost with no annual cap. Schools now knew that the students could get loans for however much it would cost. So what happens? Price of tuition goes up. In 2006, Grad Plus loan was fully implemented and opened up to all graduate and professional students, letting law, medical, and grad students borrow money uncapped, limited only by school set cost. The result, no longer limited by federal loan caps, schools continued to raise tuition, knowing that the federal loans would cover it. This is actually called the Bennett hypothesis, which was named after Ronald Reagan's education secretary, who said the following: if you give people unlimited federal loans, colleges will just raise prices. Well, look where we are now. So despite what you see on TikTok and from the mainstream media, the new law that's been passed is actually capping the federal loans and putting yearly and lifetime caps on these loans, like in 1992. So schools cannot just keep raising prices and expecting loans to cover it. Now, we all know in a perfect world it would work that way, but we don't live in a perfect world. What will probably happen is students are going to have to borrow more for private loans, and it's going to reduce the amount that students can even qualify for, but I digress. Time will tell what happens, because I personally would like to see colleges lower tuition, because I'm not too crazy about spending $5,000 a year of my hard-earned money that I'm working my tail off to collect, going towards tuition that is absurdly priced, although I am an in-state student, so it's really not that bad. But it is a lot of money. I don't just willingly spend $1,500 all at one time, or $2,500 all at one time. And as someone who's honestly considering law school in the future, I would like to see tuition rates lowered. To be honest, it would greatly benefit me if it did. And I'd love to see the price of my tuition in my graduate program go down as well. And you can be rest assured that I will report back if tuition does end up getting lowered. And I will be ecstatic about it too. All right, moving on to a different type of loan. I'm sitting in my house. Let's talk mortgage loans. Now, there's a common theme that young people are told, oh, you need to go ahead and move out of your parents' house and live off on your own and grow up and all that. No, you do realize that families used to live together, right? You know, I can understand that thinking if you meet someone and you get married, that makes sense to move out on your own. But even if you're trying to save up for a bigger goal, that's okay too. As families, we should stick together, and I think that speaks to this whole idea of being solo on your own, being trapped in a rental somewhere, not being able to pay rent because the price keeps going up or what have you. This shows that the idea of the nuclear family has just dissolved in our country. And unfortunately, you don't find families living together that often. But to be honest with you, it's beneficial. And do you pay for it? Oh, yes, you pay for it. 100%. You pay for it with your mental health. You pay for it with your privacy. You pay for it with your sanity. But you know what? At the end of the day, it's worth it. It is worth it. The cost savings from living at home are extraordinary. But the good news for all of us young folks out there, and actually, I'm not even going to say young folks, the good news for everyone in America is that rent payments now count towards mortgage loan qualification. And this started in 2021. Huge mortgage lenders like Freddie Mae and Freddie Mac, I think I'm totally butchering those, but nonetheless. Also, where did those names come from? Started counting rent payments towards mortgage loan qualification. And this is huge. But now at the federal level, the Federal Housing Finance Agency, the FHFA, has now made it mandatory for rent consideration. I think this is going to severely impact first-time homeowners in a grand way, in a good way. First, helps people with little to no credit history. Now, if you have credit cards, you have a credit history, but a lot of people don't have credit cards. Some people don't operate with credit cards. So if their credit history, there's no credit history to even consider buying a home at that point. But now your on-time rent payments are going to count towards your eligibility, which is fantastic. So now I think we can finally stop saying, if I can pay a $1,500 a month rent, then I can pay a $1,500 a month mortgage, which I think will make a difference, but we'll see. It also increases the odds of approval for more home buyers. Updated underwriting systems now use rent data as a positive factor. And for the borderline applicants, this might tip the scales in their favor towards approval or qualify them for lower interest rates. This also might help improve loan terms. Higher credit score, lower interest rate. Tens of thousands saved over the life of a loan. It'll also make the transition from a renter to a homeowner a lot easier. Connecting the financial past of your life as a renter to the financial future of your life as a homeowner. And finally, it's going to expand, or at least they think it will, homeownership access for underserved groups who have limited access to traditional credit. So we'll see what happens. In simpler terms, if you've been a good renter, the system will now actually start to reward you. So now for my final thoughts and analysis of the matter. Debt is not just financial. It's emotional. It affects your health, it affects your freedom, it affects your future. But if you learn to make it work for you, not against you, you understand how the system works. So you have to ask the hard questions, protect your peace, and don't be afraid to challenge the system, because that's the only way that it changes. I think going forward, these new changes are actually going to help us more than hurt us. Loans can either hurt you or help you, and to be honest with you, they're more hurtful than they are helpful. But if you learn that early, you'll be in good shape overall. So with that being said, I hope you guys enjoyed today's video as we uncovered what loans are and how they're a trap for the American public. But now you know, and you're prepared, and now you can do something about it. So with that being said, I hope you enjoyed today's video, and if you did, don't forget to like, subscribe, and stay tuned for more, and I will see you all in the next one. Bye.